Alright, by now everyone's memorized the journal entry for depreciation expense is to debit depreciation expense and credit accumulated depreciation. So depreciation is a non-cash expense that systematically and rationally spreads the cost of our fixed assets out over their estimated useful life. So in this video, let's talk about what number goes into that journal entry: debit depreciation expense, credit accumulated depreciation. First, let's look at the ASC, the Accounting Standards Codification. We're going to look at Topic 360, Subtopic 10, Section 35, Paragraphs 2, 3, and 4. And it just tells us that we're going to base our depreciation expense on the asset's estimated useful life, and that we're looking to spread this expense out in a systematic and rational manner. And it's a process of allocating that cost, not a process of evaluating the asset involved. Let's start out with the most common method, the one that most folks use, and the one that makes the most intuitive sense. We're going to use the straight line method, which means we're going to book the same depreciation expense every year. And this asset is assumed to have an original cost of $200,000, a residual of $10,000. In other words, after we're done with it, we think we can sell it for $10,000, and it's going to last us for 5 years. So the calculation is the original cost minus $10,000, that's the residual, divided by 5 will give us our depreciation expense of $38,000. So at the end of 1 year, our accumulated depreciation is $38,000. So our net book value, the original cost minus accumulated depreciation, is $162,000. And the straight line method means that it's the same amount every year. So every year we'll do that same calculation and get the same amount of depreciation expense. So the next year it's $38,000, the following year $38,000, $38,000, and then we keep adding the depreciation expense to the accumulated depreciation from the year before. So at the end of 5 years, our net book value is the original cost of $200,000 minus $190,000 of accumulated depreciation. So we're left with our estimated residual of $10,000. And this is the method that almost everybody uses on their books. And nowadays they use the modified accelerated cost recovery system from the IRS on their tax returns. But in the old days, there was no makers. There was no modified accelerated cost recovery system. So everybody used a bunch of different depreciation methods with the notion that they wanted to book as much depreciation expense in the early years so they could reduce their tax bill as much as possible in the early years. Accounting textbooks still cover these other methods, so let's talk about them. But what's going to happen is out in the real world, we're going to use straight line on our books and modified accelerated cost recovery system on our taxes. So one of the more creative ways people came up with to get a lot of depreciation expense in the early years was sum of the year's digits. The justification was that an asset is most productive in its early years, and so that's when we should book a lot of the depreciation expense. So what they would do is they would add up all these digits here. They'd get 15, and the first year they'd book 5/15ths. Then the next year, 4/15ths, then 3/15ths, and 2/15ths. And I'll show you what that looks like. So the sum of the year's digits refers to the denominator. 1 plus 2 plus 3 plus 4 plus 5 is 15. At this year 1, there are 5 years left, so you put 5 in the numerator, that 15 in the denominator, times the original purchase price minus residual value of 10,000. So you get depreciation expense of $63,333. Which is a lot more than the $38,000 we had in the straight line method. Then the next year, there's 4 years left out of above the total of 15. So 4 over 15 times the 190 gives you that much depreciation expense. And so you've got less and less depreciation expense in the later years, but you booked a whole bunch in the early years, reducing your income tax bill. So this was just one of the clever ways accountants came up with to justify booking a lot of depreciation expense early on to decrease their income tax bill early on. Another clever way we had to get as much depreciation expense in the early years as possible, again, based on the notion that the asset was more productive in its early years, so we should book more depreciation in those years, was either the 200% of the declining balance or 150% of declining balance. And in fact, what happened is eventually the IRS made up some rules called the Modified Accelerated Cost Recovery System that use this notion of the declining balance. So what would happen is, first of all, we'd ignore the residual because, again, remember, we're trying to book as much depreciation expense as we can. So let's ignore the residual and let's book 150% of what we would have booked on the straight line basis. So if this were a 5-year asset, we would have booked 20% depreciation in 1 year. Let's instead book 30% depreciation. That 30% represents 150% of the 20% we would have booked if we were using straight line. If we were using the 200% of declining balance instead of 30%, we'd use twice as much as a straight line, or 40%. So 30% of 200,000, remember, we're going to ignore the residual because we're trying to get as big a number as we can here in the beginning. And we end up with a net book value of 140,000 at the end of the first year. That declining balance refers to that declining net book value. So the next year we'll take 30% of 140,000 for 42,000. So now our accumulated depreciation is 102, our net book value is down to 98. We'll do the same thing the next year. So we've got 30% of that 98, so we got 29.4, and now we're getting to the point where we gotta be sure that we don't get down to zero here for net book value. We want to hit that $10,000, so we're going to have to switch to straight line. You can switch anywhere you like, but you usually wait till near the end. And so we're going to take 68,000 minus the residual of $10,000 and spread that out over 2 years. So that's $29,300 a year. In other words, take that 68.6, subtract the 10 because we don't want to go below the residual value. Spread that over the last 2 years, so 50% of 58.6, 50% of 58.6, and we end up with our $10,000. And finally, another method to book depreciation expense might be to look at the service hours or the units of production, or the activity method, we sometimes call it. So suppose we had a truck that we thought was going to last us 100,000 miles. If we drove it for 50,000 miles that first year, maybe we should book 50% of the depreciation expense that first year. So let's look at a machine that we buy. Again, we pay $200,000 for it. We think it has a residual of 10. And we think we're going to be able to run this machine for a total of 60,000 hours. So we have this machine that we think is going to last us for 60,000 hours. The first year we run it for 20,000 hours, so 20,000 divided by 60,000 total hours means that we're going to multiply that times $190,000, gives us depreciation expense of $63,333. Then the next we run it for 10,000 hours, 10,000 divided by 60,000 times the 190 gives us 31,667. Accumulated depreciation of 95, 200,000 minus 95 gives us net book value of 105. And we just keep going along that way. You have to be careful when you get to year 5. In this example, you hit 60,000 service hours about halfway through the year. So you stop the depreciation at 5,000 because now you've got that total 20 plus 10 plus 15 plus 10 plus 5 gives us that total service hours of 60,000. And so you're left with a residual value of 10,000. Well, we came up with some great ways to get a lot of depreciation expense in those early years compared to the straight line method. But that made life pretty miserable for the IRS because they could go to different companies, and one company would be using the straight line, one company would use some of the year's digits, one would be using service hours, one would be using 150% of declining balance, one would be using 200% of declining balance. And so auditing for tax returns became really troublesome. So the IRS came up with their modified accelerated cost recovery system. And so nowadays we study these things in accounting class, some of the year's digits, 150% of declining balance, service hours. But in reality, what's going to happen is on our books, we're going to use the straight line method. And on our tax returns, we're going to use the modified accelerated cost recovery system, which means you're going to simply look at a table from the IRS. You got a 3-year asset, these are the percentages you use, 5-year, these are the percentages, and this assumes the half-year convention, so it assumes every asset you put into place at the middle of the year, every asset you took out the midway through the last year. And so that's what's going to happen. Books, straight line, taxes, modified accelerated cost recovery system. All right, hope that helps.